Hi there, welcome to Kneppy Invest. Hope this is a quick video. I am in between two 12-hour night shifts, so not a lot of time on my hands right now. But I want to do a video on DGL Group. I've already done an introduction to this company because they listed on the ASX in August of last year. But this company has been a real successful IPO. We have seen a share price almost quadruple since the IPO. Not only that, they have released quite a few profit upgrades, at least two anyhow, and the share price right now at this very minute, I'm recording this video at 3 p.m. on Wednesday, 20th of April. Share price is at an all-time high after the company released a profit upgrade on the 19th of April. So I'll be talking about that profit upgrade, and this is my favorite sort of announcement from a company. Some investors, some traders will tell you always sell on news. This is the sort of news you don't sell on because you can see the share price of a company run up from here and keep on running up for an extended period of time. And when I say extended period of time, I'm talking about years. I have seen this before with companies where when they release profit upgrades, it could be the first of many, and you just see the share price explode. Doesn't mean that will happen for DGL Group, but it just increases the probability that it will. DGL Group is primarily a chemical manufacturing company, but they also are into warehousing and distribution and environmental solutions. So in terms of revenue, you're talking about chemical manufacturing, about 97.3 million in financial year 21, environmental solutions, $63 million of revenue, and warehousing and distribution, 40.9. Founded in 1999 by Simon Henry in New Zealand. And I was a little bit wrong with the listing, 24th of May 2021. So almost 1 year on the ASX. I tend to wait at least 6 months before I take a position in IPO. Not all the time. I have only waited 3 months in the past. I have taken a position in DGL Group based off their half-yearly report. There was also a profit upgrade in the half-yearly report. That was a catalyst for me taking a position. Now, lots of skin in the game when you talk about Simon Henry. He owns 54% of the company. But not only that, he has been acquiring more shares. He bought $500,000 more shares in late December. So he is obviously quite bullish about the future of this company. That could be one little negative, that he has a significant stake in the company. In my opinion, it's not a negative. It's actually a massive positive that he has such a large stake in this company. And the market cap has gone over 1.1 billion. Now, that share price of $3.79 was at the end of trading on the 19th of April. I just had a look at the share price. It was over $4 now. So it's gone up another 7% so far during trading on April the 20th. And the T code for this company is, naturally enough, DGL. I'm just going to touch upon their half-yearly results that they did release in February. And this is straight from their presentation. I just want to focus on a few things. The first thing I always look for when deciding whether to buy into a company is whether we do, or the company does, have revenue growing through time or cash receipts, particularly if I'm only looking at Appendix 4Cs or 5Bs. That's definitely true for DGL Group. They've seen sales revenue grow from 164 million in financial year 19. Pro forma means if you assume the acquisitions they made, they've owned since that year. So that's not exactly true. So pro forma revenue is going to be a little bit different than their reported revenue if they were on the ASX at that point in time. But we do have access to their financial results in financial year 19 because of the prospectus and the IPO process. But anyway, $164 million of revenue in that year pro forma. In this half year, the first half of financial year 22, that's up to 143 million. So they're almost got to the point where they've created more revenue, or nearly as much revenue in this half year than the full year in financial year 2019. Not only that, they broke it down to organic growth and revenue through the acquisitions, 29% organic growth, and acquisitions that contributed 23 million. And just as you would think, because revenue is growing, we're also seeing EBITDA grow, profit grow and EBITDA margins are growing. Now, a lot of companies will focus on EBITDA, and that is one thing they will focus on. So revenue, EBITDA, particularly if they're doing guidance and those sort of things, very popular. I prefer other metrics, but EBITDA is a rough proxy of some other metrics. We're talking about profit, operating cash flow, free cash flow. Those are the ones I prefer to see. But the most important thing here is EBITDA, sales revenue, all growing. Also, the margins are growing as well. And this becomes very important when we look at the April 19 profit guidance upgrade. We are seeing significant expansion in the margins based off their previous guidance. And that should become clear when I talk about the most recent guidance they did release on April 19th. One slight possible negative is they also break down their customer concentration. So the top 2 customers they have equate to 19% of the revenue. So if they lose one of those customers, that would be a significant hit to this company. So that is something you have to keep in mind. But I'm not sure how long they've had those customers for. It could be long-term relationships. And the key with this company, as it grows, the importance of that concentration at the top end will become less and less. And if they lose a customer, it won't have a significant hit on the company. The other thing I'd notice here is revenue by industry, and there is a lot of diversity here. So 34% in agriculture, this is the revenue. So 34% of the revenue is agriculture, 26% environmental, 19% auto, 16% warehouse and distribution, and 5% water. Now, before I have a look at the most recent guidance that they did release on April 19, just want to go back to the half-yearly report because they did upgrade their guidance from the prospectus. So this is looking at revenue and normalized EBITDA. So revenue in the prospectus for financial year 22, they were forecasting $210 million of revenue. They upgraded that in the half yearly to 343. So a significant increase in revenue. And EBITDA, they were expecting 29 million. That upgraded that to 54 million. So almost double EBITDA. So a lot of tailwinds behind this business. One question is, how much further could these tailwinds go? It could be a few months, but the management is quite positive that these tailwinds will last through the rest of financial year 22. I'm thinking it could last for the next few years. That's just a possibility. So that's one of the reasons I took a position in this company. The other reason I took a position in this company is just a positive sentiment behind the company. And you'll be able to see that positive sentiment when we look at the chart and the share price action over since they did IPO. Now to their guidance, so they did release on 19th of April, and this again is in regards to revenue and EBITDA. Not a large increase in revenue, only from 343 million to 354 million. But you'll notice that the increase in EBITDA is 11 million, exactly the same as the revenue increase. So EBITDA is expected to increase from 54 to 65 million. So this is telling us there is significant margin expansion in this business based off these new expectations. So the $11 million in revenue is going straight to the bottom line. This is one of the reasons the market has become excited with this announcement, why the share price has taken off. Now to the weekly chart, actually the daily chart, sorry, for DGL Group. No point looking at the weekly chart just yet because this company IPO'd less than 1 year ago. Really interesting chart, very different from the chart you see for a lot of IPOs where there's that initial hype, share price increases over the first few days and then pulls back a fair bit. One of the reasons I like to wait a little bit of time before I take a position in a company. But when DGL did IPO, the share price was actually less than $1. And that was the low in the share price, the historical low in the share price for this company. You could argue that the valuation of this company was underpriced at the IPO. Maybe they could have IPO'd at $2, which would have brought more money into the business. But the share price has kept on increasing because of these tailwinds behind the company. Share price actually did increase quite a bit during August through to October of last year, increasing from about $1.40 to $3.20. That $3.20 is a very important price level, a nice resistance level. It was a resistance level anyway. That's that horizontal line. We reached, or DGL reached, share price of $3.20 in September, and it tested $3.20 twice, once in late December and then again in February. Both times it tested that resistance level, it pulled back. About a month ago, it tested again, And the market was a little bit hesitant. It wasn't quite certain which way to go. Share price went up and then pulled back. But the 2 days leading up to April 19, we did see a fair bit of buying, and the share price went from $3.10 to $3.50. You could say there was maybe some loose lips up there. But the release of this profit upgrade has really put the burners under the share price over the past few days. Share price increased 8% on April the 19th, and then another further 7% on April the 20th. That's not to the end of trading. That's with 1 hour to go. Now, another line I put in here is the uptrend, which is a sloping dashed line from when they IPO'd, and the share price has tested that uptrend a few times during its history, about 4 or 5 times, in fact. So that is a strong uptrend, and that is our selling point, or my selling point, moving forward. If the share price moves below that uptrend, particularly on strength, that would be a sell signal, but we're well away from that uptrend right now. In fact, that uptrend would be probably about $2.90, $2.95. So we're about a $1 higher than that uptrend. So a lot to play with here. No reason to sell out right now. In my opinion, that's just me, because this upgrade or profit upgrade cycle may not have come to a completion just yet. That's all I have for this video on DGL Group and their profit upgrade. I'm not sure if this is a short video. It was almost done in one take, so that does seem short for me, but I can ramble on sometimes. So if you do have any questions about DGL Group, I'll just leave it in the comment section of this video. If you have some thoughts about this company, I'd love to hear your thoughts as well. Now, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.